Okay, so now the time. Okay, welcome back. So let's start the keynote session. So it is our great pleasure to have Professor Philippe Bacchetta as a keynote speaker to this year's conference. I'm sure that everybody knows that Philippe is a leading scholar in the field of international macroeconomics finance. If you don't know, I think you must be attending the different conference. So, but let me briefly introduce Philippe. Philippe is the Swiss Finance Institute professor of macroeconomics at the University of Lausanne and the chairman of the Department of Economics. And Philippe is also the program director of the International Macroeconomics and Finance program of the CEPR. He's a fellow of the European Economic Association and has been a president of the Swiss Society of Economics and Statistics and a member of the Swiss National Research Council. And Philippe has numerous publications in top academic journals, such as 4 in American Economic Review, Journal of European Economic Associations, JME, JET, JIE, AJ Macro, and many more. I think I will be running out of time by just introducing Philippe's influential work. So without further ado, Philippe, could you start your presentation? You have 45 minutes for presentation, followed by 15 minutes Q&A. And if you have questions, maybe you can either post in the chat or say in the loud voice in the Q&A session. So that please, Philippe, could you start, please?
Okay, well, thanks a lot for this introduction. Thanks to the organizers for inviting me to talk about my work here at this conference. I'm really sorry this conference is not taking place the way it was supposed to in Seoul. I had plans to come to Seoul and sit in the same room with everybody, but well, let's try to do this online and hope that the line is good until the end of the talk. So the paper I'm going to present today is a paper with Eric van Winkoop. It's part of a larger project where we look at the implications of delayed portfolio adjustment, and the motivation. The initial motivation is the fact that there is a widespread micro evidence on limited adjustment or infrequent adjustment by investors, by many types of investors. There is a larger literature on that. Just here mentioned 2 recent papers, a recent one on Gilio and others on US retail investor, and also one that we are just finishing this week on international equity mutual funds that document this slow adjustment in portfolios. It's true that on the other hand, in the FX market, there's a huge volume, and there are many like frequent traders. There are robots, etc. But our view is that while robots are not rich, in other words, those frequent traders don't have large positions, and at the end of the day, in equilibrium, will not impact the dynamics, at least in the medium term, of the exchange rate. And that's the assumption we make, that this frequent trading cannot offset the majority of investors' delayed adjustment. When we make this assumption, in an extremely simple model that I will present, and we can show that we can explain many of the puzzles of the exchange rate. We've chosen 6 puzzles because it seems this is the standard in international macro after the Upsell-Rogoff paper. Now, the background for this idea or this issue came from a paper by Fruit and Thaler a few decades ago. They were looking at the 4 discount puzzle, looking at the various explanations, and in the end they concluded that well, the most likely explanation, according to them, is the fact that indeed the investors have a delayed portfolio adjustment, and in later years we wrote a paper formalizing this idea of Fruit and Thaler and showing that quantitatively this delayed portfolio adjustment could explain the data for the 4 discount puzzle. And the question is whether this feature can also explain other aspects of exchange rate behavior. The paper we had in 2010 was relatively complex, and we could solve it numerically, but it was difficult to really see what was going on. We could not address all the issues given the complexity of the model. So here what we do in this paper is to present a much simpler approach, much more transparent, that allow us to look at different aspects, to revisit the forward discount puzzle, but also look at the other puzzles. So that's the basic motivation for this paper, trying to find a simpler way to model this gradual portfolio adjustment. So what I will do for this talk is to talk about the puzzles we examine, and then show the model with portfolio frictions, show the optimal portfolio and the implied equilibrium exchange rate. And then we will go through the 6 puzzles and see how this solves it. Once we have the model, then going through the 6 puzzles is relatively straightforward, and then I'll conclude. So 6 puzzles, some are very well known. So the first one is the delayed overshooting puzzle. If central bank increases its interest rate, there will be a period of appreciation followed by gradual depreciation. This is a feature in the data that we find in some samples in some countries, not always. But there's some famous paper that showed for the US this happens. For other countries, for Japan, it does not. But this is something that we observe in some cases. Second puzzle is a forward discount puzzle. When you have a high interest rate, your currency tends to have a higher expected return in the near future, so you can make money out of that. But if you look at the longer horizon, if you have a high interest rate, actually the expected returns becomes negative, and we call this the predictability reversal puzzle. As you increase the horizon for the expected return, it goes from positive to negative. And this is something that in general is very difficult to explain. We showed that feature in our 2010 paper, but I think most models have difficulty explaining that. A fourth puzzle, we call it the Engel Puzzle, that was described in a 2016 paper, where it showed that high interest rate currencies are stronger than implied by UIP. We would see that these puzzles, this Engel puzzle, is related to this predictability reversal puzzle. A fifth puzzle, this is based on a paper by Gali, a recent paper looking at forward guidance, and he coined the forward guidance exchange rate puzzle. If UIP holds, the exchange rate is just related to the undiscounted present value of interest rates. So interest rates very far in the future have the same impact on the exchange rate as exchange rate in the near future. But in the data, that's not the case. Interest rates in the near future have much more impact. Finally, maybe a less well-known puzzle, we call it the LSV puzzle, from a paper by Lustig and et al., a recent paper in the AR, where they basically revisit the forward discount puzzle, but instead of using short-term deposits for interest rates, they look at the return on long-term bonds. And they find that if you take, for example, monthly returns on long-term bonds, well, they are not predictable by the short-term interest differential. And so why is it that it is not, there's a difference between long-term bonds, the return on long-term bonds, and short-term assets, and we will try to explain that. Okay, so these are the 6 puzzles that I will go through. Well, towards the end, maybe the last one, I will have to go a bit faster. I will probably not have time to go in the details, but I will show you the model and the results. Now, the model will introduce portfolio frictions. And the way we will do it is to assume an adjustment cost to changes in portfolios. And here we follow a paper by Garliano and Peterson, a finance paper, where they use this approach. It's a simple approach to represent a slow or delayed portfolio adjustment. It's basically a quadratic adjustment cost. And this approach sounds very simple, but it has the advantage of being very tractable. You don't need heterogeneity of investors. The problem when you have infrequent trading is that in general, you have many types of investors that trade at different times. So most of the literature assumes that you have overlapping agents that change their portfolio every, say, T periods. So you have, then you have the number T of different investors, and this is very, very complicated. This is done again in most of the literature, many papers in finance. We also did that in our 2010 paper, but then it's very, very complex. You can only do this, solve this numerically. An alternative to model infrequent portfolio adjustment is to assume that agents change their portfolio with a probability P, like a Calvo price setting. So this is like a portfolio adjustment with some probability. That we analyzed that in a previous paper that we are currently revising. But this is also very complex because well, you have to follow the wealth of the agents and the different portfolios. So this heterogeneity makes things very complicated. So there's a trade-off here. We take a more reduced form approach that actually, in the end, gives some similar equilibrium equation than the other approaches. But on the other hand, it allows us to solve the model and examine analytically most of the puzzles that we want to analyze. So the basic model, the basic setup is first we use real variables so that we can talk about real exchange rate. We don't need to think about stationarity. We assume real exchange rate is stationary. And this works well because most of the puzzles we look at can be either in nominal terms or in real terms. So here we just do the real terms. Now the model I will present is somewhat reduced form. In the appendix, we show that we can derive this model based on a more general equilibrium model with the price stickiness, etc. But here it's really a very simple version. What also we simplified in this part is that we only have one type of explicit shocks, which are interest rate shocks. They can be, interest rates can come from a Taylor rule or etc. But here we just look at the shocks to the interest differential. The other shocks are in the background. The other shocks will affect exchange rate volatility. So we will match exchange rate volatility, but we will not look at the impact of the other shocks. We do this in the appendix, but that's not the focus of this paper, the model. Basically what we are looking at, and all these puzzles, they look at the relationship between exchange rates and interest rates. So this is really the focus, and this is the tradition in the literature. So we just focus on that. So it's a two-country model where agents hold the nominal short-term bonds of both countries. But when we turn to the last puzzle, the 6 puzzles, we need to introduce long-term bonds also. So there would be a model with only short-term bonds that will deal with the first 5 puzzles, and then I will introduce long-term bonds for the last puzzle. Now the model, as you will see, is simplified in a couple of ways. We assume that the agents have short horizons, and they are basically overlapping horizon agents, where basically they get an endowment in the first period. They allocate this endowment into their portfolios, and then they consume the return from the portfolio. And then there's another generation that comes. Their portfolio in the foreign bonds is called Z. And since there are 2 bonds, 1 minus Z is a portfolio in the domestic bond. And the objective function is just the consumption next period. Okay, that's standard. But well, maybe just mention that this short horizon allows us to derive things analytically. If we have an infinite horizons, we get related results, but we cannot do this in such a simple way. So this is an important assumption. But the main ingredient of the model is the second part, is this adjustment cost, quadratic adjustment cost, to the change in the portfolio and the portfolio share. And the cost is, the parameter in the cost is psi. So psi will be the key parameter in the model and in the results, and everything will depend on psi. When psi is 0, this will be the frequent trader case, and we will need psi non-zero to be interesting. In the background, there's also a tax on foreign investment to justify the home bias. For most of the results, this home bias is not key. It will be important in the last for the last puzzle, but it's just in the background. It's redistributed as a lump sum transfer. So that's basically these are the assumptions. We will derive the optimal Z from this objective. Before I do that, I want to present some notation that I will be using. The real exchange rate, capital Q, the log excess return, the real excess return is the log real exchange rate appreciation. So the Q is, say, foreign currency appreciation, and RD is the interest differential. So this is the excess return of investing in foreign currency. The variance of this excess return is sigma square, and there will be the home bias parameter, and then also there's a B, which is basically representing the supply of assets available to foreign investors. Basically, you correct for the home bias, so it's convenient to use B instead of having the H everywhere. So we will use this B to simplify. So when we use this notation, we can write the optimal portfolio in this form. And I think this is the interesting part to show how this portfolio works. So we find that the portfolio is made of 2 elements. The portfolio times T is related to the portfolio times T minus 1, plus what we call ZF, which is a frequent trader portfolio. So ZF is just like a mean variance portfolio plus a constant that is related to the home bias. So when our psi, when our cost of adjustment is 0, well, just see that Z is equal to ZF, and this is a standard frequent trading case. But when psi is non-zero, well, you see it's a weighted average, and the larger psi, the more weight you have on zt minus 1. Actually, to look at the impact of psi, it is interesting to replace zf in the equation, so we can relate z to the expected excess return, and we find this equation here. So the portfolio today is related to the portfolio of yesterday and to the expected excess return. And what is interesting is how it reacts to the two. When it is a large weight on the portfolio, on the last portfolio, you have persistence. And you see that when psi is high, you have more persistence, which is not surprising. But also, when psi is high, you react less to the expected excess return, which is it's an interesting feature, because usually, well, the models with standard risk aversion makes you react too much to the expected excess returns, and with this low adjustment, you just react less. So with the more cost or higher psi, you have more persistence and lower return sensitivity. Instead, if you look at risk aversion, which is another parameter we will consider, with more risk aversion, you have less persistence and less return sensitivity. So this is what I just described is in this slide here, and basically we are it's important because we don't know exactly the value of psi and not sure about the value of gamma. So we will look at different values for psi and gamma, and we will see that some of the results will occur only for intermediate values of psi, and we will also see that the intuition for the results is based on these two effects of portfolio persistence and return sensitivity. Okay, maybe before I turn to the equilibrium, before I turn to the exchange rate equilibrium, let me just make a comment on this portfolio, which is derived analytically. And you could see that if we can estimate the expected excess return, we could run a regression with that. So this would be a perfect way. It's a very simple reduced form that could be checked empirically. So we do that in this paper we are finishing this week that we can circulate next week. So we test a related expression where we have a model with infinite horizon, and we find that with infinite horizon, zt depends on zt minus 1 and on the expected excess return, but over several periods, a discounted expected excess return. We have some estimate for that, and we run these regressions, but we do this with equity investment using mutual fund data, and we find that these parameters A1 and A2 are strongly significant. So this specification is consistent with the data when we have equity investment. Unfortunately, we are not able to do that for the FX market for short-term positions because we don't have the data. So just to mention, so we have an equation that can be tested empirically, but we looked for data. We can have data on fixed income assets. We can have data on long-term bonds, but having outstanding short-term bond data, we were not able to find that. So maybe in the future we'll do that. So this equation at this stage cannot be tested directly for the FX market. Anyway, we just take it as it is, and we now solve for the equilibrium exchange rate. We assume that foreign investors have a similar behavior, that their demand for the foreign bond is Z star, and the supply of foreign bonds is 1 in real terms, so that in the end, the market clearing condition is just this equation expressed in domestic currency. So it's a ZT plus ZT star QT, which is the real exchange rate, and this is equal to the supply, which is 1 times QT. From that, we substitute our equilibrium ZT and ZT star that depends also on the real exchange rate, depends on the interest rate, as we saw. And we can derive the equilibrium Q, and we log linearize the solution, and we find our equation 1. So our equation 1 has familiar ingredients. You see that if psi is 0 and if theta is 1, then this is just UIP. Now, if theta is not 1, you still have psi 0 but gamma positive, then you would have a kind of a portfolio balance model with a risk premium. And then when you have a psi, then you have a lagged real exchange rate, so that the equation becomes the second order difference equation instead of a first order. So the ingredient is to add this order in the difference equation, which naturally will lead to more interesting dynamics. We can also rewrite the equation as the expected excess return or the risk premium depends on this risk factor, which is standard, the gamma sigma square b. But also this adjustment in the real exchange rate. So you have this additional term that is affected by psi. We solve this difference equation, so we solve it forward, and we get that Qt is related to Qt minus 1 plus the expected present discounted value of the interest rate. Alpha and D are the roots of the characteristic equation. You can see that alpha and D depends on psi. If psi is 0, well, then alpha is 0, and D is just equal to theta. So that the weight of the past exchange rate depends very much on psi, and the discounting depends also on psi. With more psi, you have more discounting, and this is obviously related to the fifth puzzle. We'll show it later. Yeah, so that's the solution. Then what we do is to assume simple behavior for the interest differential. We will assume that it follows an AR1 process. So behind you could be like Taylor rules for central banks in the two countries, but the difference between the two countries is just an AR1. This makes things simple. So then our exchange rate equation is just becomes this one here, this simple one that depends on the current differential and the past real exchange rate. So using that, we can, for example, derive analytically the expression for regression coefficients. We will run regressions. For example, in the pharma regression, you run the excess return on the interest rate. And usually it's the excess return that's t plus 1, so 1 period ahead. And then you can derive the beta 1, which is the pharma coefficient. Here we can derive it theoretically. We will also look at horizons, a longer horizon. It could be 1 year, 2 years, so t plus k, which will have a different beta k. This will be important for puzzles 3 and 4. We can derive this analytically. So that's basically that's it. That's the model. So we designed the model to have it as simple as possible. Again, there are some shortcuts like quadratic adjustment, myopic, but this allows tractability and intuition in the results. Okay, once we have the model, we can go through the 6 puzzles. We can derive analytical results for the first 5 puzzles. The 6th one is more tricky because we have to introduce long-term bonds, and there we have to go numerical. I will not show you the, we have some propositions. I will not show you the equations for this presentation. because we also do numerical illustrations, and I will show you the numerical illustrations. If you want to the analytical results, you can just look at the paper, but for the presentation, it's better to have pictures than having long formulas. For the numerical illustration, we do some small calibration. We take the US versus the other 6 G7 countries. We estimate the persistence of the interest rate differential rho, and its and the volatility of the exchange rate. We match the home bias parameter, but for psi and gamma, we don't. We cannot match these. We don't know them very well. So we will have a range of psi and gamma, and we take as a kind of a benchmark value psi 15 and gamma 50. It's a high value for gamma, but we think that the model is very simple. So if we want to match some aspects, we need a high gamma. If gamma is lower, you will see that our effects are stronger. So it is not the high gamma that drives the results, and we will show you the range. Okay, so now let's go to these 6 puzzles. So I have about 14 minutes left, and that means about 2 minutes, a bit more than 2 minutes per puzzle. First puzzle, the delayed overshooting. So let's look at an impulse response function of an increase in the foreign interest rate. If you increase the foreign interest rate, the real exchange rate or the foreign currency will appreciate. If you have a UIP holding, you will have the red line here. So QIP is the behavior of the real exchange rate, assuming UIP. So if you assume UIP, the foreign interest rate increases, the foreign currency appreciates on impact, but then depreciates. In this model with delayed portfolio adjustment, while the interest rate increases, the agents keep adjusting their portfolio, keep buying the foreign assets. So there will be an appreciation. You see on impact, the impact is much smaller because of, well, there's less adjustment, there's a cost of adjustment. So the adjustment is small on impact, but then over time, the exchange rate will keep appreciating. And then, well, you have a turning point. Here it's about 35, these are months, 35 months. Turns out that in the seminal paper by Eichenbaum and Evans, they estimate the delayed overshooting. They find that, well, it's, that the range of the turning point is around 30 months. So this is in line with what was found. Let me show you the next graph. The next graph will show you again this impulse response Q on the left. So this blue line on the left is the same as in the previous one. We have this hump shape. And what we do on the right is to look at the time at which you start to depreciate for different values of psi and gamma. So here we change psi on the axis, and then we look at 3 different values of gamma. When psi is 15 and gamma is 50, here on the red line, we get the turning point at 35 months. When you increase psi, you have a longer or higher turning point. So you have a longer delayed overshooting. And this is not surprising because when the psi is large, you have more persistence. With more persistence, you have more delayed overshooting. Instead, for gamma, it's the opposite. It's when you have a lower gamma that you have a higher turning point because the gamma has a lower gamma increases persistence. So that you see that our point here is just an illustration. It could be anything, but we need psi to be, well, large, 510 to have some delayed overshooting. Okay, so that's for the first one, delayed overshooting. That's I explained. Okay, then the forward discount puzzle. So the next puzzles, let me maybe just go back. We use this equation, this excess return equation. So the forward discount puzzle is to see whether beta 1 is non-zero. So it should be, if UIP holds, this should be 0. And pharma shows that, well, this is non-zero. In our case, it is positive. That's what we show here. What do we find for beta 1? This is the value of beta 1 for different values of psi and gamma. If we take our value of psi and gamma, psi 15 and gamma 50, we get something like 3.5 for the beta. And you see we get different values depending on psi and gamma. What is interesting is that you have this sum shaped, meaning that you have a high beta and predictability for intermediate values of psi. Why? Because of the two impacts of psi. On the one hand, a higher psi gives you more persistence, which gives you more predictability. But on the other hand, a higher psi gives you a lower response to expected excess return. And this means that the exchange rate will react less to expected excess return, and therefore you have less predictability. So you have this impact, which is large for intermediate values. Instead, for gamma, the higher gamma, the more predictability you have. Okay. So that's forward discount puzzle. Then when in this equation we increase K, it has been shown, we found that in our previous paper, and then in other papers, Engel and others, they've confirmed that, this beta K decreases when you increase K and even turns negative. So here what we do is to run the regression with different horizon, and then we look at what happens to beta K. And that's why we have here. This picture here on the left shows beta K in the model for psi 15 and gamma 50. We show that indeed when K is 1, I showed you before, the beta 1 is close to 3.5. And then as K increases up to about 30 months, then it starts to be negative. In the data, that's about what we find, that after a certain horizon, after about 2 years, then there's no predictability, and then the predictability turns negative. And the time of the sign reversal is also affected by values of psi and gamma, showing on the right-hand panel. So there, the reversal is higher with higher psi and lower gamma because of more persistence. So we can also match that. The fourth puzzle, the Engel puzzle, it says it shows this covariance between Q minus QIP, which is a deviation of the real exchange rate from the one that is implied by UIP. So Engel shows that when you have the foreign interest rate is high, then its currency is high compared to what it would have been with UIP. And UIP is just the present value, the undiscounted present value of interest differentials. That's the standard. Now, to have this negative relationship, actually, we can show that this is related to our beta K that I showed before. We need that the beta K are negative. The sum of the beta K is negative. Why? Because, well, initially, when you have a high interest rate, your currency appreciates. So when beta K is positive, you get you have an appreciation, but then you get a depreciation. So if you have enough depreciation, it means that in equilibrium, your real exchange rate will depreciate in the end, which means that it is it is overvalued today. So when you have enough, so you need to have enough negative here, so that to make sure that the exchange rate over time will depreciate compared to the UIP in exchange rate. So what we do simply is to take the sum of all the beta k. We want to see whether the sum of all the beta k is negative, and Engel has some estimate for the sum of all the beta k, and we compute this in the model, and we find that the sum of the beta k is negative. And when we take our preferred case, benchmark case with psi 15 and gamma 50, we get a value about minus 20, and this is in the range of what Engel has estimated. So this is for the fourth puzzle. Time is running. The fifth puzzle, this is straightforward. The exchange rate is the present discounted value, and the discount rate is given by the psi, is influenced by the psi. We find in our simple numerical case that d is 1.29, but of course, if with UIP d is 1, and with psi 0, d is very close to 1. So here we can explain that. Finally, in the last 4 minutes, I need to talk about the sixth puzzle, when we introduce long-term bonds. In that case, the model is no longer analytically tractable, but I will just show you the results. We have long-term bonds at where the coupons decline slowly over time. That's a standard way of introducing long-term bonds. So then the agents will maximize their utility, but now there are 4 portfolio shares, because they can invest in foreign short-term and long-term, and home long-term and short-term, so that they find the optimal portfolio. We have 3 endogenous variables now, not only the real exchange rate, but also the price of long-term bonds, PL and PL star. For short-term bonds, we still assume that this is decided by central banks, and then we have this AR process. Then we use this model that I'm not showing to compute coefficients of some regressions. We look at the 3 excess returns. The first one is the one we've been looking at, the excess return for short-term deposits. Then we have the excess return on long-term bonds, the monthly excess return for long-term bonds, or L. And then we have the difference in say the term spreads in the 2 countries. Now, when we do that, and we compare to the data from LSV, so the data, this is the lower line here, they look at these 3 excess returns. So the standard one in the first column, the next one is for bonds, and the third one is for this these return differentials between long and short. We can match the short term well, and what we find is that for the long term returns, well, they find 0.65, which is not significant. We also find that it is very low compared to the short term returns, and the reason is that you have this difference in the return differentials. So in 1 minute, this is difficult to explain the details, but let me just give the intuition here. When you have the foreign short-term interest rate increasing, what happens is that foreigners will start to sell their short-term bond and buy the long-term bond. Sorry, foreigners will sell their long-term bond and buy the short-term. So long-term bond prices drop. And because of home bias, this is the main effect. Home investors will also buy more of the foreign short-term bonds. They might also sell part of their long-term bonds, but the main effect is the sale of long-term bonds by foreigners. This means that the price of long-term bonds, of foreign long-term bonds, declines. The return on long-term bonds declines compared to short-term bonds. So when you have such a shock, on the one hand, you have this appreciation of the foreign currency, which makes a gain on the foreign assets. But at the same time, you have an increase in domestic bond price, and here it's difficult. Well, it's fast, I know, but you have a decline in the foreign long-term return. So on the one hand, the foreign currency appreciates. On the other hand, the long-term return decreases. These two compensate, so there is no excess return on the foreign currency, on the foreign currency long-term bonds. So my time is up. So to conclude, we have introduced this simple model with international portfolio frictions. We can solve these 6 puzzles. I think there are more. We can we could have talked about momentum, for example. We might do this in a new version of the paper. And this simple portfolio adjustment cost has the advantage of analytical tractability. We're actually now used in some larger model, and we found that this was very convenient. Now, this was a simple model. We find these results that are, I think, very nice and intuitive. And of course, to go one step further would be to have a more complete model with this gradual portfolio adjustment and check whether this really holds when you have a more complete general equilibrium model. So thank you.
Okay, thank you very much, Philippe, for fantastic presentation with a simple model, but which can explain so many puzzles. You know, I tend to make a complicated model with a very few implications, very few implications, but this is great. So that I'd like to have a question. And can I ask Andy to start the question? Could you, Andy Filado, could you unmute your microphone? And if you have a question, raise your hands or just send me the chat. You know, I have a question. Okay. Next, I would like to ask Dave. Yeah.
Okay, so my question is the following. I think this model of portfolio adjustment is really great when thinking about what pension funds and insurance companies do. I mean, they have a strategic asset allocation. They tend not to change it very often, and therefore you get these kind of frictions you wouldn't expect in textbook models. But when we're thinking about banks, in the big international banks that are arbitraging or traditionally have arbitraged markets, they have a different problem. They have regulations and capital requirements, and these seem to be driving the CIP differential, UIP differentials, and things like that. And so that seems to be missing in this model. So it seems like this model captures a lot more of what insurance and pension funds are doing and much less about what big banks are doing. Do you agree with that, or do you see some sort of bridge between those two views?
So I agree that we don't have this. So we see the banks as the frequent traders. And because of their this regulation, restrictions, limits to exposure, etc., their like overnight positions tends to be small, and therefore they are present in the market. They may drive the market say during the day, but overall, the way we see it is that they will not offset the dynamics set by the large investors. In our previous paper in 2010, we had a portion of frequent investors, which represented about 5% of the market. And this was about the estimate in terms of transactions. We talked to FX traders, and the estimate of basically the outstanding positions of these frequent traders was about, at the time, was about 60 billion. But we could have some estimate compared to the total wealth of portfolios. So the amount, what we care about are the portfolios at the end of the day or at the end of the month. And these banks, indeed, they would have an impact. And if we really want to go finer, we should model them. But our point here is that they do not, because of these restrictions, they do not undo the behavior of larger players in terms of portfolios. If you look at portfolio data at the end of the monthly portfolio data, they may be large. They're not so large compared to other types of portfolios. So that would be my answer. So indeed, it's a very important issue. If we want to look into like a deviation from CIP, we should go into that. But for like a more medium-term exchange rate behavior, we make the assumption that these institutions, because of the limits you mentioned, are not offsetting the dynamics of the exchange rate.
Okay, thank you very much. So the next is Dave, then Mario, and Mick. So could you start, Dave? Dave Cook.
Sorry, hi Philippe. I found this model to be very convincing and intuitive. It occurs to me that my initial guess would be an implication would be that that the actual quantities of capital flows at aggregate levels would be kind of very persistent and predictable. Is that behavior that you see in the data?
Oh yes, sure. Well, again, so we see this in the for short-term positions. We don't have the data, like the bank positions and all of that. We don't have the data. When in the portfolio data, again, you can have fixed income, but this mix is long-term and short-term. It's very difficult to isolate the type of positions that we would have in this model. Where we have data is for like equity. We had this study about mutual funds. Mutual fund represent 60% of portfolios for equity. There is, huge persistence. It's really persistent, and yeah, all the data that we see for international portfolios is persistent on a monthly basis. But we don't have. So I cannot answer your questions well because we don't have this data which we model in the FX market.
Okay, I was also kind of just wondering at the aggregate level. So you have fund managers at kind of the micro level, but also the aggregate level. No, seems like it's available.
At the aggregate, well, I looked. Maybe some of you can give me some hints, but I tried to look at short-term bond or deposits, short-term positions at the aggregate level. And I didn't find it. You find again portfolio fixed income, so one category, or banks or bank lending or others in the balance of payments in the portfolio. But we don't know exactly what is in the banks. We don't have the monthly aggregate positions for short-term assets.
Okay.
I didn't find
thanks.
it.
Okay, so Mario, could you ask your question next?
Sure, thanks. Wonderful presentation, Philippe. So you're talking about a lot of different trading parties in this discussion, I guess we have been, but you've got one objective function with margin utility of a representative agent and a fixed portfolio cost. So I'm just trying to think about how you feel about navigating across delegated investing and high frequency traders and so forth with this model that really doesn't have those features of heterogeneity built into it.
Okay, so there are, I think, well, two types of heterogeneity that at least we had in other models. One is among the infrequent traders, so they may be heterogeneous because they trade at different times. And then there is heterogeneity between infrequent and frequent traders. Well, it turns out that we initially in our model, we always had both infrequent and frequent, so that with different objectives, etc. But when you solve the model, the portfolio, the equations, actually, it is the result is very similar, and you can more or less reproduce more frequent trading by reducing the adjustment cost. So I could have a model with frequent trader with a high adjustment cost for the infrequent, or a model where without frequent, but I lower the adjustment cost. In the equilibrium, it is the same for the equilibrium exchange rate. Then of course, for more detailed aspects, it will make a difference. But if we just look at the equilibrium solution for the exchange rate, introducing separately frequent traders does not help. And actually, we had this in previous models, and always the referee would say, or the discussant would say, well, why don't you get rid of the frequent trader, because they don't help you anything in the solution. So we had it, so it was more realistic. But in the end, it was enough to just change the parameter of the infrequent to make them a little bit more frequent on average. So that's so I would say I don't feel so uncomfortable not having this heterogeneity for the questions we are looking at.
Are you okay, Mario?
Yeah, I was just thinking, if you think about the marginal investor determining the price, whereas the quantities might reveal more of the heterogeneity of the underlying objectives of the traders. Maybe there's a way to parse the quantities and prices to help on some of those dimensions. That's just a remark. I mean, it's helpful.
Right. Now you can derive what the implicit marginal investors. Again, for some aspects, maybe for pricing, etc. Maybe this could help. Yes.
Okay, next I would like to ask Mick, could you turn on your video on the microphone?
Oh, okay.
Yeah.
Oh, okay. Yeah, fantastic presentation, Philippe, and really nice paper. I think this is going to make it onto a lot of graduate reading lists because it's so easy to exposit. I have kind of two questions, fairly quick questions. The first is, I mean, can you kind of match this phi parameter into, you know, anything really we see in the real world, like, you know, capital requirements for traders or regulations about domestic investment on the part of pension funds or leverage limits or anything? I mean, is there some way that you can kind of pin it down institutionally in the real world? And the second one is, I'm a little kind of confused. There seems to be a bunch of papers now introducing frictions in DSGE models with exchange rates and financial markets. So for instance, the Gavex Majori paper and a recent paper by Itzkoki and Mukin, who you know, claim that they can solve at least some of these puzzles, like the forward discount puzzle. So is your paper different in the sense that you can encompass a much wider range of these puzzles, or what's the relationship between yours and those other papers?
Yeah, thanks, Mick, for your questions. Interesting. So the first aspects about trying to quantify from some maybe institutional aspect, we don't do that because the way we see it and the way it started with fruit and dollar is that the reason why you have infrequent adjustment, maybe multiple, but it could be transaction costs, maybe it could be regulation, but it could be also for information costs, psychological costs. Well, it takes time to kind of revise your portfolio. I mean, if you think about yourself as your portfolio, you are not going to change your portfolio every day. It takes an effort. Pension funds, they need to meet with the board, and it takes time to analyze and take decisions and decision making, and this is very difficult to measure. So we don't see that this infrequent or delayed adjustment is only made by transactions costs or regulation. This is only to us is only a small part. So I don't think we would be able to directly estimate this psi. This would be difficult. It's more about if we can look at the actual behavior of the funds, etc. There we can try to infer this cost indirectly, but directly we don't it is more it's more difficult. It's not just based by these institutional measures. For the second question about the other DSG models with frictions, I think the delayed adjustment introduces a more dynamic friction. So it gives, indeed, we can many models can explain the forward premium puzzle. What models cannot explain is the reversal, the sign reversal for predictability. This is something with the dynamics that makes it different. So Garbe Majori or Mukin, they can solve also, maybe they can solve more other puzzles because they have I would say, a broader model. They can address more issues than we do. But when we look at exchange rates and interest rates, I think these frictions we are looking at helps explain the dynamics of exchange rates and the dynamic relationship between exchange rates and interest rates, and can match that, and the other models cannot.
Okay, thank you very much. So that we have maybe many questions, but the time is up. So please join me thanking Philippe for fantastic presentation. So you can find a reaction icon at the bottom. Then there's a clap option. So let's show the clap option. Yeah. Thank you very much.
Thank you very much. Thanks.
Thank you very much. And okay, so we're gonna have a short break, and the next session will start 3:10. So Gino, is it right? So now we wanna take it.
Break.
Okay.
Okay.
Thank you very much. See you soon. See you later.
See you soon.